Over the past week, we've seen some pretty significant bank failures, and these failures can be very confusing to understand. So in this video, we'll discuss some of these bank failures, why they happened, as well as how the central banks tried to resolve some of these issues at these banks, and my thoughts on the situation overall. Hey everyone, it's Jonathan here, and let's get right into it. So the first thing we have to understand before we start talking about necessarily why these banks failed, we first need to understand how a bank works in general. So generally speaking, usually a bank will accept deposits from depositors, people who want to deposit their money at a bank. Then with these deposits that the banks collect, they could do a couple of different things with them. They could lend it out to other clients in terms of like a credit card or a mortgage or a personal loan or a business line of credit, so on and so on. They could buy debt themselves, so like maybe buy like government bonds, like treasuries, or even bonds of corporations that are issuing bonds, or even mortgage-backed securities as well. Or something else they could do is just take the cash that you deposit at the bank and they could just hold it. Now, with each one of these decisions, there are significant risks with them. So if you go and you take the money that someone deposited into your bank and you lend it out, well, as the bank, you are guaranteeing that depositor back their money. So if you lend it out to somebody and they don't pay you back in full, well, then now you have a little bit of a shortfall. And this risk gets heightened much more, especially during recessions, where we start to see softer labor markets. So wages aren't as strong, which causes people to reconsider how they spend their money. And they may decide, hey, this auto loan you just gave me, I'm not going to pay it back. And that could really mess up the bank. Then there's also the risk of holding cash where, like everyone else, if you hold cash, you have an opportunity cost of, well, if I lent that money out or if I had produced the income with that money, it would be worth a lot more than it is if I just hold on to it and keep it like in a mattress or in a safe for this case or anything like that. There's also inflation as well. And then the risk with buying debt is that there's this thing called interest rate risk. And pretty much what that is that let's say you buy a government security like a 10-year treasury. And the going rate for a 10-year treasury is, let's just say it's 2.5%. And then let's say you buy that treasury and then a year later, the going rate for a 10-year treasury is now 5%. Well, think about it. Which one do you think the market would be more enthusiastic to buy? The 10-year treasury that yields 5% or the one that yields 2.5%? Well, obviously, the one that yields 5%. The value of the actual treasury does end up decreasing when rates go up. So now since we have an understanding of how banks work, let's now move on to talk about some of the bank failures we've seen over the past week. So the first one I want to talk about is Signature Bank. Pretty much with Signature Bank, what happened is that with most traditional banks, especially the bigger ones, they weren't really open to working with crypto firms. So a lot of crypto brokerages like Coinbase or the now bankrupt FTX or Voyager, they will usually take on money that people put onto their platforms. And they would need somewhere to be able to deposit this money as a custodian of that money that you keep. So like, let's say, for example, you're using Coinbase and you keep like $1,000 there so you could buy crypto immediately. So you have to put that money somewhere, right? Well, because of this, it gave a lot of these smaller banks a lot more leverage over these crypto firms. So these crypto firms will turn to banks like Signature Bank to hold custody of clients' funds. And because of this, it allowed a lot of these regional banks to give very little to almost no yield on these deposits. So now these banks like Signature had a massive war chest that they could use to go and buy to go and make loans or to go and buy bonds. And what Signature did, they bought bonds with long maturity dates. And this is kind of the sensible thing to do given the fact that interest rates were so low during the pandemic. But the problem is that when interest rates are like near zero and you buy bonds at those rates and then it starts to move up, you could get burned very quickly. And that's basically what happened to them. The best way to think about this is that think about if you have like a 10-year treasury bond that yields 2%. And then a year later you have a 10-year treasury bond, but now if you buy it directly from the treasury, you get a 5% yield. Well, obviously the 5% yield is way more attractive than the 2% yield. So the value of the 2% yield bond goes down. So even though the higher yields did let the bank become more profitable, the fact that they didn't hedge against the possibility of rates going up did cause them to get burned once rates did go up, and that caused them to have a lot of unrealized losses on their books. And then to compound on top of that situation, the crypto market also took a hit as well when interest rates moved up. So it caused a lot of crypto investors and a lot of crypto companies to have to start withdrawing money from their bank to be able to fund their operations. And generally speaking, usually for like crypto brokerage companies, their revenue is based on the volume of transactions they do. So if they do less volumes of transactions, so that means that their revenue will go down. And that's what happened when the crypto market started falling. These companies, they pulled money out of their accounts, which meant that the bank would have to realize the losses on their treasuries. And because of that, they pretty much eventually just became insolvent. And this is almost the same thing that happened at Silicon Valley Bank as well. It's just that in the case of Silicon Valley Bank, it was actually tech startups and not crypto. There was actually an article I was reading in Bloomberg. I believe this was almost March of 2022. And it was talking about how a lot of VC firms were being much more stringent about their valuations, ideals they threw money at. This was at kind of the start of the Federal Reserve's quantitative tightening campaign. So because of this, a lot of startups were not very encouraged to raise money. And they started to burn through some of their cash deposits at the bank. And just like Signature Bank, they were very upside down on a lot of the assets that they held, which was mostly treasuries. So pretty much that came to fruition and they became insolvent as well. And that's kind of where the FDIC came in and took over the bank. So on Sunday, we saw the FDIC, the Fed, and the Treasury issue a joint statement, pretty much talking about how they plan to shore up the banking industry. And the Fed provided a facility that banks could borrow from called the Bank Term Funding Program, or the BTFP. So pretty much in this program, the way it works is that banks would pretty much give their treasuries that they have on their books and their mortgage-backed securities to the Fed. And the Fed will issue a 1-year loan to the bank at par value. And pretty much what par value is that it's a pretty widely used term where it's pretty much if you bought a bond and let's say you bought it for $1,000, so you pulled $1,000 out of your pocket and you bought the bond. That is the par value of the bond. That is what you are promised to be paid back once the time frame of the bond is over. So if it's a 10-year bond, in 10 years you'll get that money back, and then every so often we'll pay you your interest. And this was very important because there's really no one else in the private banking industry give a bank that kind of loan. Because think about it like this, most of the time, if someone gives you a loan, the reason why they're giving you a loan, including a bank, is because they can make money off of it. They see oh, well, you're not so risky, so we're going to give you a loan at 4% because they feel like they can make money on that loan that's at 4%. But if they feel oh, there's a chance that you might not pay, then they might say, okay, well, for you, we're going to give you a 12% loan for the same exact thing because we're not sure if you're going to be able to pay us back or not. The government's really the only entity that can actually do this because think about what the Fed's going to do. They're pretty much just going to go into their spreadsheet and just add more money. Then they're going to take that money and give it to the bank in exchange for their assets. And then in a year, the bank pays back the Fed. And then the Fed gives them back their assets. And then the Fed takes the money that they paid them back, gives it back to the Treasury. The Treasury takes that money and lights it on fire. That's one of the beauties that the Fed Fed and the Treasury Department have that a lot of other private market participants do not. And this was in addition to what the Fed already has to help banks with liquidity, which is called the discount window. And this has always been around for a very long time. Generally speaking, it's usually a higher rate than the BTFP. This covers more of a wide array of assets, not just treasuries and mortgage-backed securities. But you do have to be a qualifying borrower to be able to use this facility. So it's a little bit more stringent than what the Fed did announce on Sunday. It wasn't only Silvergate and Silicon Valley Bank that also had issues. On Wednesday, we did hear from the Swiss bank, or the I think they call them the National Swiss Bank. They're almost like the Fed of Switzerland. And they came out to bail Credit Suisse. And they pretty much issued a $54 billion loan to Credit Suisse to keep them afloat. The Credit Suisse situation is a little unique because they've had all kinds of different scandals. They were caught up in the whole Archegos 100x leverage situation. they kind of have a lot of different issues with them even before the Fed started hiking rates. So they're a little bit of a special case. They are another bigger bank that is failing, that is very systematically important to the entire global market. And then on Thursday, we got some news that First Republic Bank, which is another kind of like San Francisco techie bank, compared to Silicon Valley Bank, they're a little bit more exposed to like private and individual wealth. So kind of the best way to think about it is like, oh, well, Facebook, like the corporation, might do their banking at Silicon Valley Bank. But then Mark Zuckerberg, himself, probably does his banking at First Republic Bank. And I'm not saying to say that either party does actually use these banks. I'm just using that as like an example to kind of show you what the typical client looked like at these different banks. And pretty much what happened is that they had another liquidity issue. The Biden administration didn't want to come in and make it seem like they're bailing them out, because obviously bank bailouts are very unpopular politically. So what the Treasury Department was able to do was to convince a lot of the like really big and a lot of the like kind of big banks to deposit $30 billion into First Republic Bank to try to keep the bank solvent. I do remember back when Voyager collapsed in the middle of the summer in 2022. I believe it was like mid-June or something like that. I did end up making this tweet where I was talking about how the people who had their money at Voyager were FDIC protected. But the issue with FDIC protection is that it only protects the member banks. It doesn't actually protect the third party in the situation. So let's just say, for example, you had $1,000 on Voyager and Voyager goes bankrupt. And let's say Voyager took your money and deposited it at, I don't know, Silicon Valley Bank. Well, FDIC insurance only protects you if Silicon Valley Bank goes bankrupt. It doesn't protect you if Voyager goes bankrupt. If for whatever reason your deposits get tied up with Voyager, then you have to wait. You may have to wait till the bankruptcy proceedings are over to recoup all of your money, if you even do, depending on how the bankruptcy court classifies your deposits. This made me start to think that, okay, well, if that's the case, well, if I'm at, let's just say, for example, Wealthfront, and I hate to say Wealthfront because I actually like them, but I just want to use them as an example. If, let's say, my money was at Wealthfront and Wealthfront takes my money and they deposit it into, I don't know, let's just say Chase, for example. Well, if Wealthfront went bankrupt and for whatever reason the money that I deposited at Wealthfront got tied up into the bankruptcy, there may be a chance that A, I don't get all of the money that I deposited in there, and also B, that I may have to wait years before I could get access to that money. This was something I did tweet out in mid-June, and it did seem a little ridiculous when I tweeted it. And even looking back on it, I thought it was a little bit ridiculous too. Now, here we are today in a situation where we're seeing where that might actually happen, or that has a possibility of happening. Honestly, I doubt something like that would happen, but it is something good to think about. What are my thoughts on like this whole banking situation, what's going on? So let's first talk about the bank management. So honestly, I feel like the main cause of a lot of this pain that we're seeing with these different banks are kind of the cause of this poor management at these banks. When we think about what happened at Signature and Silicon Valley banks, in my opinion, both these banks were just very poorly managed. You know, the Fed was kind of like, had like this bat signal for like the 6 months before they even did their first rate hike, where they pretty much telegraphed to the market, hey everyone, we're going to hike rates until we get rid of inflation. And we're not going to stop until inflation goes away. And that should have been a pretty clear sign that maybe you shouldn't be in long duration treasuries and you should get to more of the shorter end of it. And, you know, in the case of Silicon Valley Bank, they had way too many of these long-term debt assets, which was in stark contrast with what a big bank like JP Morgan did, which is they actually had significant amounts of cash going into the Fed hiking cycle. So in that way, they could pretty much buy up as soon as the yields went up over time. And it was almost like a way for them to hedge themselves just in case the Fed goes much further than they expected. I believe a lot of market participants at the beginning of 2020 did believe that we were going to only see about 2 to 3% of Fed hiking. And now we're knocking on the door of 5%. So, and we're still seeing inflation start to slowly come down, not even come down rapidly. So, and then in the case of Signature Bank, they just had way too much exposure to crypto. You know, going into a Fed tightening cycle, usually holding assets like crypto aren't really a good idea just because they don't really have any intrinsic value. And I know I get so much hate about this. Oh, you don't know what you're talking about. The price of Bitcoin's going up. What the fuck are you talking about? Yeah. Whatever. It's not really something you want to have when the Fed's acting as a headwind against your investment. So obviously, because of like the turmoil that happened in the crypto market in 2022, this is why Signature Bank just kind of got screwed as well. And they should have tried to reduce their exposure to crypto more and try to attract more deposits before the Fed started that rate hike. And I saw this article also in Bloomberg as well, and it was actually talking about I think it was like a CIO for some like hedge fund or something like that, where he was actually talking about that some of the most dangerous investments you can make is rapidly growing financial companies. And that fits right into the bill of Silvergate, Silicon Valley Bank, and Signature, because they grew very fast during the pandemic. That also does bring into this talk like SoFi, Affirm, Upstart, Robinhood, those kind of companies too. And pretty much the reason for this thinking is just that, generally speaking, in financials, you really have to balance risk and reward. A lot of these financial companies that grow very fast, the reason why they're able to grow so fast is because they have very little or very loose risk avoidance procedures. So I thought that was something pretty interesting that I did want to mention in this video, that if you are someone who is investing in these kind of companies, maybe you want to hold off investing in them, or maybe you only want to invest in them up to a certain portion of your portfolio, or only invest in them when there's actually when there actually is tailwind, not headwind from the Federal Reserve. I don't know. That's just something I'm thinking about. So when it comes to kind of this big bank, small bank talk, I think that the overall risk of contagion from what's happened over the past week with some of these smaller banks is very low. And this is mostly given the fact that a lot of big banks tend to be very well diverse. They don't have as much risk, mostly just because of some of the stress tests that the Federal Reserve does put on these banks. So the biggest 8 banks get the most stringent test. Only banks that have more than $250 billion worth of assets under management actually get tested. And because of this, they usually are managed much better and they are more risk averse. Kind of like what I was saying earlier about Chase, that they actually had a lot more cash going into the Fed tightening cycle, which really saved them from a lot of the heartache that's going on with a lot of these regional banks right now. What I would do in this situation, so last June, when I sent out that tweet about the fact that the intermediaries are not FDIC protected, that actually got me to thinking that I should just move all of my money, like all of my like securities and my money to like bigger banks. And that was actually what I ended up doing. And I think now in this situation, if I had a lot of money at a smaller bank, I may consider moving it to a bigger bank, at least just for the time being. Definitely anything more than $250K, because whether you're at a credit union and you're using NCUA, I believe it is, or you're at a commercial bank and you're using FDIC insurance, if you're over $250K, you're not protected. But then also, even if you are protected, you may have some headaches to go through with those agencies trying to get your money out of those accounts. And then also, credit unions do fall into the category of small banks as well. My goal isn't necessarily to fuel a bank run and to make it worse, but I think that it is very important for you to be very cognizant of the fact that whether you're at a bigger bank or a smaller bank, you can wake up and that bank might fail and you might not be able to get your money out. For me personally, right now, I kind of have like 2 banks that I do business with. I'm considering opening up a third one. There are some of the bigger banks out there. The third one I was considering opening was Bank of America. Personally, I'm not a big fan of Bank of America, but if I had to pick a number 2, that would probably be the number 2 I'd pick. When it comes to bank stocks and kind of trading off of them, I think that it's very difficult to trade off these banks, mostly just because bank runs are usually fueled by human emotion. So if we hear any like news that like, oh, another bank might fail, that might cause you to get trapped one way or the other in terms of your trade. You could do calls, but the problem with calls right now is that, like, for example, like First Republic Bank, right now the volatility on that is crazy. So you if you bought calls, you could be directionally right, but because you would probably get volatility crushed, it might not be worth even executing that kind of trade. But then now if you go long or you go short, you might get caught on the wrong side of the trade. So for me, I don't think I'm going to be playing the banks personally. I think I'm just going to kind of observe what's going on and just make sure that the other investments that I make in are kind of in par with what's going on. So I'd like to thank you so much for watching. As always, please like, share, and subscribe, and I'll see you in the next video. Peace.